The private placement life insurance, I'm not sure if you misheard us saying we do private placement investments. I'm not familiar with the term private placement life
Oh,
insurance.
I know what he's talking about. So I actually
Okay.
put this in the Mastermind Discord channel last night. So what they're talking about is it's I don't know, it's advanced for the most part. But what I would do is I would recommend doing research on what's called an ILET if you're interested in this type of stuff. It falls more into the IUL type of vicinity. But if people wanna, this is Biden guys are trying to like close this loophole where you're able to pass off your estate tax free by just passing it off now before they close this loophole. For people under $5 million net worth, it's probably you're gonna pay too much more money to make this make sense. I would tell Justin, don't worry about it, man. Get your net worth to $5 to $10 million and worry about that stuff. But I'll put in an article if you're interested. Here you go.
Yeah, I think we covered the whole life or IUL. Index feature for Guardian was a question. Yeah, how long does it take to access the money? Yeah, 2 to 3 business days via ACH. That's if you go through the online portal. There are some companies that don't have an online portal, and you may have to either fax or fill out a call the agent. Most companies we use do have that online portal. The death cash value in life, if you can, so a question is as far as qualifying for an accredited investor, if you can use the cash value in your life insurance policy to qualify for that. That is, if you choose to disclose that, it would be just like, unlike a bank account where they can pull a credit report and they can maybe see what you have. These are really private, so you would have to disclose it to whoever is qualifying you. I have in the past when I went through investor or verifyinvestor.com, I just had to take a screenshot of the portal to show what the cash value was, and they used it.
That's thorough for them, right? You get, yeah, like these verification things. I've seen it go so many different ways. When I co-sign on 20, $50 million deals, a lot of times I'll just take a screenshot of my cash value or the PDF and I send it over as part of proof.
Yeah.
I think that the more sophisticated the person you're sending it to, the better they'll understand what the heck it is. But if you go to your average bank, I think you're just going to end up with some bureaucratic idiot that doesn't know what the heck you're doing. So that said, it may be tricky to use it as cash reserves on a home purchase. But then if that's the case, just tell that bureaucratic guy, I'm just going to do a cash deposit into my bank account tomorrow. You'll see it there, buddy. You can look it up.
A question, can you carry a term life and whole life policy at the same time? Yes. The only thing is death benefit does go into the equation. So it's you have a overall total limit of death benefit that insurance companies will insure you for. So it does affect that, but you can carry both. A lot of people do have both.
Take these questions in as we go. I think this is good to reiterate. Why not buy term and invest the difference? And this is the sentiment that the Dave Ramsey guys always say. And I would agree with this, right? If you're figure out what is your goal, that's why you do the consults, right? What is your goal? What are you trying to do here? Most of you guys are the same. You guys want to take your money, put into a policy so you can take it out cash value, policy loan to go invest it. But if your goal is I want $1 million, $2 million of death payout in case something happens for my family, to me, the solution and tool for that is a term life policy. But it just so happens if you fund something for $50,000 for 6 years, you're going to get that byproduct too at the same time.
A question about the guaranteed dividend changing at the end of the year. Yeah, so that's that 7702 tax change. As far as by how much, the vary company Guardian has come out with most of their products. They've stated that theirs one is 3%. Other companies have come out and per product, it differs the guaranteed rate. So it's a little bit more complex in that sense. But it'll vary between 2 to 3.75% is what's mandated.
A question went away earlier. We currently have a term life policy since we have young kids. I think everybody should have that. I'm not giving any financial advice here, right? No, this is no financial advice, but I think that is prudent. We only wanted to do this until our kids are 18. If we started to do the infinite banking, well, we need to cancel the term life policy. So you don't need to cancel, you can still have it. But I would say you probably, if you're doing 50 I don't know how much term life you're getting, but if you're getting like $1 million, $2 million by getting $50,000 a year for 6 years in a whole life policy, that kind of suffices for that. So most people, what they'll do is they would cancel the term life and save that, was it $500 per year, whatever that costs.
Yeah, and the other, I think the last one we've answered, when we're going over the example about not funding it every year, yeah, we just want to clarify, we weren't suggesting that's the ideal way of doing it. We were just covering the downside of saying, what if you can't do it? It still will perform, but yeah, the most efficient way is to fund it every year.
Yeah, it's like buying like 7 containers. Why only fill up 3? You could if you wanted to. I would say you try and right size it, maybe go a little bit more than you think you can. Like we said, because the splits, the commissions are so low, or the life insurance component is so low, you're going to hit your minimum of cash dumping into it in the first year, most likely. So you don't have to worry about it collapsing, cannibalizing itself. But why would you not want to fund it every year? If you have, say you lost your job one year and things are a little bit rough, cool, just catch it up on the next year, skip a year. But luckily that's where you put your money, right? That's where you're holding your emergency savings account, as it earns 4 to 5% tax free. And that's the beauty of this. I think let's go to the open questions.
All right. How much money does someone need to contribute to build up the cash value to make it worthwhile? That's probably a personal question, but the numbers, so that the illustration we showed, you can add a 0 or subtract the 0 or cut it in half. It performs the same way as far as numbers wise. The value will be different however much you cut it up, but the way it performs number wise would be the same. So I think, Lane, you mentioned probably 15,000 target would probably be the minimum. And yeah, I agree in the sense that the base premium then at that point is $1,500 a year. So you want to try and stay above that the $100,000 death benefit of whole life per year, or else you'll lose a lot of the kind of the side benefits, like that enhanced benefits rider. You won't be able to get the most highest rating. If you get the highest rating, you still just get the non-tobacco rate health rating and have slightly higher fees. It gets less efficient the smaller you go.
Trying to see who this Mr. Michael is, get a little context, because everything, that's what I do. I look your guys' profile up and I see the question behind the question. I don't know what Mr. Michael's net worth is. I don't know his situation, because actually he fell off the investor list because he stopped answering emails. So Mr. Michael, if you're out there, please re-sign up for the club. And if you guys don't open up emails, my system eventually purges you from the system. So please be aware of that. But if Michael was $1 million net worth or more, yeah, I think this is a no-brainer for him. But if Mr. Michael barely has any money, like I said, it's not for the lower net worth guys. And therefore, if you're doing a policy for $5,000 a year, I'd say just save up the money, buddy. Like, it's not worth the headache for you to do it, in my opinion. I would say at the bare minimum, $10,000 a year would be the bare minimum. But I would say try and at least do $30,000 a year, especially if you have liquidity or home equity, not doing anything. Run it through this thing.
Yeah, and I think it's important, like you've mentioned it before, this is not for everyone. Yeah.
But most people here are higher paid professionals, higher net worth, certainly going to be there on Credit Investor Plus at some point. This definitely comes in, I think, when your net worth goes over $500,000. But talk to Tyler. He'll give you guys 2 cents in that too. You guys talk personally.
The next question, what if interest rates go up over 4%? I'm not sure exactly if you're asking for loan interest rates or the dividend rate, but
I think dividend rate, right? So right now, interest rates, yields are low, right? So 4% is pretty good. If the interest rates environment goes up, does our dividend rates go up?
Yeah, so that's a good, historically, the dividend and the interest rates, they all follow each other. I would say as loan interest rates go up, dividend rates go up also, and vice versa. There are floors though, so a lot of times now we're at a floor or below the floor. So even though interest rates go up, you may not see the loan interest rate go up because there's a lag, and also it may not reach the corporate Moody bond index may not go over the 4% floor for loan interest for a while.
But I think it's a good question from Mr. J here. And I had the same question, right? I don't want to have FOMO in case interest rates go up and I'm stuck here at my 3.5% that my insurance company pays me for it. I should have done it later. Even if it was that case, you don't want to have that attitude. The whole point is you're not really parking the cash here to make the 4%, 5%. You're taking the money right back out and you're investing it. That's the whole idea we're doing.
Yeah, so it makes sense to take policy loans for an investment. Does it ever make financial sense to use the loan for something smaller? I would word that as a liability.
Doodads, some stupid whimsical purchase. Yeah, you can do whatever you want with it.
Yeah, and I would say for me personally, it would make sense if you are, especially for a car, if you are financing it and you're paying another financial institution that interest. So in that case, there's ways you take out a policy loan and then instead of paying the financial institution $500 a month or so in car payment, you pay back your policy loan. So for me personally, that's when it would make financial sense. I'm a true advocate of using it either to buy an asset or cash flowing asset or recapturing interest that is going somewhere else. So those are the two things I personally use my policy.
Yeah, this is definitely off topic, but I'm going through like exoticcarhacks.com. It's a fun little, you guys always ask what are fun things I like to do. That's the kind of stuff I do on my free time. But with cars, you're able to get a loan for much more than the car is worth, which seems really irresponsible, but it allows you to extract a lot more money off of the value of the car to use cheaper debt. But even though the interest rates might now be like 5-6%, that's still it's a loan, right? That's not other people's money. Now, Tyler's exactly right. I think a lot of car loans these days, especially if you go longer than 60 months, is going to be in your higher than what you would be paying in one of these policies. Certainly, if you're doing a third party loan from one of these little banks that a lot of the advanced people are doing at 3.25%, that's the way to do it. This is for some of you guys who still buy rental properties distressed. This is the place to sit $500,000 while you're still making 4 or 5% tax free on the money while it's sitting there, so it doesn't quite burn a hole in your pocket. It's making something off the table of litigators, the asset protection component. But when you want to buy that house distress, you can go write a check a couple days. You can take the money cash value from the other deal. I think most people here have moved on from that type of stuff, but some of you guys might come back to that type of lifestyle because you're quite frankly bored and just looking for something to do in financial freedom day. It's fun. It's the hunt. And then this gives you the war chest to do that.
All right. The next question, what do you mean by $100,000 per year policy? Do you mean you paying that amount in premiums for the year? I think we covered that as far as the premium breakdown. So typically when we're saying if it's $100,000 a year policy, that's the target amount. And then where the premiums would be, or the base premiums would be 10% of that, or whatever the premium split, 20 or 30%. But yeah, we're often talking about the target amount is that dollar amount. That's not what you're committing to.
If you guys look in that past section or go to the policy illustration example section, the video when we're scrolling through those real illustrations, that person in that illustration is putting down 50,000 a year. I think most people here, they get up to a point where they're doing 100 grand a year. And then in 6 years, they built up $500,000 plus of cash value where they can go deploy and use that as kind of their family slush fund.
Did we cover the inflation? So the insurance companies are also investing that money or buying bonds, things of that sort. So it should grow with inflation, just maybe lagging a little, but eventually catch up.
Yeah, and I think this is, what is your assets backed by? Like some people like to put money in BlockFi or these DeFi crypto staking platforms where they're making 8, 10, 15% per year. But the question is, what is it collateralized with? What's the backing of it? And in that type of format, that's the reason why it's getting such a big rate, because it's really a loosey-goosey system where this life insurance contract that you're going into business with the life insurance company, it's very secure. What they're investing in is very like low risk, Class A assets in primary markets, and mostly their investment perspective is just for capital preservation. So the money that you have with them, the companies, the foundation is very fiscally responsible, strong balance sheet.
I'm gonna Couple, I think the question they misunderstood. So the growth from the investments benefits are not taxed. The growth within a policy can grow tax deferred. You access it tax free by policy loans. When you take out that loan and then you go do an investment with, that'll get taxed normally how a normal investment will get taxed. So I think that's what you're asking.
Yeah, it's important to make that distinction because for a lot of people starting out, this stuff is very confusing. But yeah, it's separating two things here.
Yeah, I think this is just the second part of that question. So it'll be very similar to the HELOC. When you take out that HELOC money and go do an investment, that investment gets taxed. Under what circumstances can you access the money if you need it? It's really, as long as you have there's a cash value within the policy, you can access the money. So there's no underwriting for the loan. You're basically just requesting it and it shows up.
And I think that's a fair question because, with retirement plans, that type of stuff, a loan or withdrawals, you always got to substantiate it with some kind of hardship or there's limits. None of the such with this. And HELOCs, the bad thing, what I don't like about HELOCs is, and this happened in like 2008, 2010 is when things kind of got topsy-turvy. The banks pulled all those loans and you didn't get access to it, which I really don't see that happening with these types of policies. The asset is back. It's life insurance. It doesn't make much money, but it's very secure asset. So I wouldn't imagine any of these life insurance policies would pull the loan or freeze the loans on these types of things.
What was the law change and impact on IBC? That was I think we answered this.
Do you know why what was the code? Why they did that or any context?
It was really pushed by the insurance companies because it helps them. They were honestly struggling to keep up with the 4% guaranteed rate. So this allows flexibility in this true low interest rate environment. Now they were like Guardian was able to inject a lot of other benefits. So it's not like a huge detriment to us as policyholders. And you gotta keep in mind that still, that's why you want to go with the mutual insurance company, is that the strength of the insurance company gets paid back to you in dividends. It is making them financially stronger. They're giving it back in different ways, I guess more they can control, but their loan interest rates also for some of these policies are reducing or lowering. So instead of maybe a 6%, it's going down to a 5% policy loan interest rate. So there are some other benefits to it.
Would you say that it was like a consumer protection or makes things a little more transparent for consumers?
It was more from what I know, it is more pushed from the insurance company.
Yeah, because we're in a low yield. Investors are starting for yield, and it's hard for the insurance companies to provide it. And that's something for people to understand too, right? Like a lot of these laws are the way they are is because the insurance companies are very high lobby. They have a lot of influence in the way tax code is written too.
The next one is just I guess someone signed in late, but it is being recorded, and Lane will be posting these. So.
And you guys will have access to the entire eCourse here. We know we skipped over a lot of like FAQs that we cleaned up for you guys. And we'll put all these recordings in the individual sections. That's why I was starting and stopping the recording. Sorry for that. The final product will be this infinite banking eCourse, which you guys can refer to. What will probably happen is like when I first did my policy, I kind of only knew half of it. That's all I really needed to know. Other wealthy people were doing this too, and essentially how they were doing it. But then you kind of, as the years go by, you start to see it actually working for you, right? As the policy comes up to a substantial amount of money, over $100,000 of cash value, you start to get even more confident in it. And then you start to want to understand the little nuances because you're a little bored. I think a lot of us we enjoy learning about these types of financial hacks.
How do you figure out your max death benefit? It's a generic number based on your age, and it's really your stated earned income. It's a multiple of your stated earned income based on age. So the ballpark is in your 30s, it's 30 times your annual income. In your 40s, it's 25 times. In your 50s, 15 to 20 times. And then in your 60s, it's usually 10 times your annual income is the max death benefit.
But the best way is just to book a call and then just see on those policy illustrations, just see where yours lines up to be. But again, we're not configuring this to death payout. So if you're older, younger, It doesn't really change it too much because it's not predicated on the death payment component.
I should share that with the newer product, where you're able to get a higher MEC for a lower death benefit. It does help some, maybe the borderline earners where they're trying to stuff in 50,000, but based on their annual income, they can only, and the calculation for the death benefit, currently they're not able to do that because the death benefit required is too high. But now that in the new product, the death benefit required will be a lot lower and you're still able to do maybe the 50,000. So it'll be probably easier for maybe some lower income earners to qualify. I'll let you take this one, Lane.
Oh, now these are some good questions, guys. So the question was, if you're just out of college in your first jobs, when you should consider the whole life IBC. And this is not from some young whippersnapper. This is from a investor thinking about their kids, right? From one perspective, from just an insurance perspective, sure, this stuff is infinitely scalable, right? Big and small. So if they want to get it, they can get it. But I think this is an awesome idea to give this to your kids. And it really teaches them how, like, you have different places you can put your money and make different varying levels of yield. Here in this case, they make something halfway decent, like 5%, which is hell of a lot better than what they're going to get in their bank account. Sure, they have to plan and wait a couple of days to get their chunk of money to buy a PlayStation or video game or whatever they want. But I think this allows them, you don't learn about this stuff unless you do it. So I think this is an excellent idea, even for younger kids too, potentially. Although you start to run the whole argument, is it worth your time, the pain in the butt factor for a smaller policy? But then again, I guess kids completely fall under the category PETA. But if it teaches them, like, how to manage the money the way that the wealthy do, I'm all for it. And I think this is something that is if you do this for your kids, it's very different from what their peers are going to do. And that's, in a way, I think you want them to understand that they live a very different life than most people out there doing things the traditional way. So if you want it, you can fund it, they can own it, you could own it. There's different configurations on how you want to do this. You probably want to own it if you're concerned about your college kid dropping out and becoming a crackhead. That's always a thing. And you can embed it in your trust and do what's called, again, you want to Google ILET. It's not really talked much these days because the estate tax threshold is higher than normal. But that'll be becoming more of a topic that we'll discuss more in the future and bring up the clients. But
yeah, maybe I'll answer. So I think personally, if you're right out of college, working your first job, it matters what you're investing in. Again, these policies, you are giving up the liquidity upfront. So it's costing you that 17% or so, or 13% or so upfront that first year. If you can go ahead and use that 13% and do an investment instead, and you need that 13% to make every dollar work, especially early on, IBC is probably not, doing it right now is probably not the best idea, because you're going to give up that liquidity. I would say put that money to work first and then come back later, in a few years maybe.
For most of you guys listening, if you guys are under $250,000, $500,000, don't do this, because you guys need to go buy rental properties, and you guys are already on like the forefront of pulling down 30 grand on the turnkey rental for 100. So you don't want to be paying, every dollar is super precious to you guys when you guys are broke like that. So you don't want to be putting that to fees. But most of us listening who are going to do this, you're going to pay the fees, but you get the utility that you're going to really see in the next 3 years, even well beyond that. A lot of the break-even points are 5 to 6 years on these types of things. But what I was thinking here for this specific scenario, Tyler, was this kid is in college. He's another 2 years away from even thinking about buying a rental. So now would be the time to load the policy. So when he actually grows up and actually looks to actually invest 2 to 3 years later, this policy is primed and ready to go.
Oh, yes. Yeah. Got it.
Tyler and I are both very passionate about passing generational wealth and these ideas of this. So,
all right. Is the MEC irreversible? Can you a year or two to turbocharge and then get back under the MEC limit? So the MEC is not irreversible. Once you MEC, the policy becomes a modified endowment contract. There may be ways of slightly supercharging, which we can go into details on a one-on-one call or whatever. I can go over some of those tricks, but yeah, it's not irreversible.
Mr. Justin is the classic case of the guy who sits around for a couple of years and missed out on all his gains that he could have been doing it with it while he tries to figure it all out. That's probably maybe 5% of the population here. But again, I'm just mentioning it because there are some people that like to get wrapped up in these details. I honestly didn't even know what MEC was for like 2 years. And then I figured out what it was. I mean, you're buying a commodity here. It's life insurance in a way. It just needs to be configured in the right way.
This is a common question. Wouldn't it be advantageous to continue paying the premiums even after the 7 years? The typical answer would be it may. We can't necessarily give a blanket answer. So there are times when, yeah, you continually want to pay the premiums. There may be reasons you don't want to open up another policy, or my standard one is that at least with Guardian, when we're maximizing the cash value, you're able to continue paying as long as you want. It just may not be the best use of those dollars, having it work the most efficient, and instead divert those dollars to either another policy. It's not you're paying the premiums either way, whether it's a long funded policy or you're opening up another policy. The premiums and costs are all relative, are all the same, just structured slightly differently.
I'll add on to that, like in one situation where I think everybody might fall in this category. A lot of you guys are on the fast track. Your situation would be drastically different in 5 years. Your financial outlook would be very different. You just got to get started doing this stuff. So in 5 to 7 years, your job will change. You're going to increase your investment holdings. You're going to be in a lot different place, and you're more than likely going to want to like double, triple the size of your policy that you're putting in today. So if you start off with 30 grand, you may want to put 100 grand after the first few years. So that's my angle on this question here. And I'm always like, especially when you're starting out, just get a smaller policy and just get it going. And if you have to get another 6-7 year policy right on top of it in a year or in 6 months from now, then awesome. Just a little bit more paperwork. But if whatever, the mistake is waiting on this stuff and trying to figure out what is the best one. No, just go out and do a smaller one if it helps you get going further on the path 6 months ahead of schedule.
Yeah, this is a good question. So I agree with the 10/90 split too, but Nash Institute people are against it. Do you have an opinion about this? Yeah, a great question. Nelson Nash, typically, I think a lot of their designs are really like a 40/60 split. And he even advocated at sometimes not a 20/80, but an 80 where it's base premium 80, or even 100 can work at times. I think that's good for possibly the long run. The way we're structuring, especially in this group, is for investors. So I personally like the early cash value access, the liquidity there, so that I can go out and do something else. If you were to just purely look at the policy by itself and structure it maybe with a higher split, it's more for like the long funding. You're going to be funding it for 20 or even the whole life of the policy, and it behaves a little differently than what I personally intend to do with it, which is pull the money out and have it again working in investments.
Yeah, it's from a different angle. When you do it the way they do, you make a lot more commission. So if you're the salesman, it's better to do it that way. Or the way we do it is better for the client, and it just doesn't make as much commission. So that's stupid. But there's a business reason behind that. And at the same time, there's all this is, guys. Sorry if we went this long and tricked you. Like, this is just whole life insurance configured in a way, and you're overfunding it. There's a lot of different name brands out there, infinite banking from yourself, be your own bank. I don't know any other ones, Tyler, but these are just like marketing terms. It really means nothing. What it comes down to is working with one of the big insurance companies, picking the right product, and then configuring it in the right way to have it set up like how we're doing it, where it's advantageous for investors with lower commissions, lower fees, and you maximize your cash value up front. That's all it is. And that's why it's aligned with the mission of Simple Passive Cashflow, which is to cut all the crap out there, like these huge fees, all these middlemen. This is why when you do it in this way, you're able to get on the path to financial freedom so much faster. You cut out all these gains and commissions and all this other stuff. But yeah, don't tell them we told you though.
All right, the next question, how is the 90% PUA tax reported? I'm not quite sure on that question, but I would say that all money using to pay, whether it's the base premium or PUAs, that's after tax dollars. So you're paying into it after tax dollars. As far as how that's being taxed, I don't know that. I don't know if you understood that question a different way.
Yeah, I think you got it. What, just out of curiosity, like what happens when like you kick the bucket and your family gets that $2 million death payout? Does that get taxed?
So that is transferred tax free. The thing people got to watch out for a lot of times is the estate tax, though, especially if it's a large policy.
Then that's the one where like right now, if you have a couple, they can both give 11 million, I believe.
Yeah.
So as long as you don't make one of those huge policies, you don't have to worry about it.
But there's talks about that decreasing. So that's that.
Yeah, and that was like the question that came there in the very beginning about that PP, private placement life insurance. If you guys are under $5 million net worth, disregard what I just said. Don't worry about it.
If we're going over premium finance whole life, not in detail, but that's something offline. We are diving into it.
Just as a definitely, we're gonna guinea pig it with you guys first for sure, as we do it ourselves personally. But again, there's a lot of marketed terms for that type of stuff. Velocity banking, premium financing. It's all the same thing. It's all just IUL product with a contract with a bank that gives you the leverage.
Are we supposed to overpay the policy loan as a way to backdoor fund the cash value? That is one way. Typically, the way is you're max funding it upfront and then you're taking the loan out. So you've already almost gone up to your max ceiling limit. When you are paying back the loan, you can choose to pay more, and that just drives down the effective loan interest rate or what you're being charged. Similar to the sweep strategy using a HELOC, if people are familiar with it. That's something I do at times also. Whenever you have your income or paycheck come in, you can pay down your loan, and then as expenses come due, you take it out. You're keeping your policy loan as low as possible. But for this specific question, the way I like to think of it is you already max funded it, and then you take out the policy loan.
Like what some people will do with those HELOCs is they'll set up their checking account to pay all their bills that also pays their HELOC. I haven't found out a way to hook it up completely in line with your life insurance. Perhaps something will come on in the future, but it's easy enough already to make your payment up if you want to do it that way. But that's essentially it. I think Justin, this is new to Justin. Like it's very simple. We talked a lot about more advanced stuff that which you really don't really need to know, but that's effectively what we're doing here. We're stuffing this whole life, and that's why it's called whole life overfunded, with a bunch of money, and then we're taking that excess, taking it as a loan. A lot of people who have W-2 salary, more consistent income, consistent expenses, which I would say most of you guys are, the strategy will be taking every single last penny of that cash value and going out and investing it, because there's a higher better use out there. Personally, as a business owner, and I think this speaks for a lot of business owners, you guys know, sometimes you can have increases in income, decreases in income. Sometimes you might have to buy a CapEx expense. For me, I keep a lot of dry powder on the side just in case we might have to bring in extra money into a deal as a general partner. So I like to keep a lot of dry powder in my cash value policy, and I don't invest it completely. I like to keep at least several $100,000 of dry powder just to add into a deal in case the pool cracks or something like that, so that we don't have to do a cash call, and I can just loan money to the deal or throw in cash as a general partner sponsor. But I would say that's a very rare case. And for most of you guys are just putting the money in, taking it right back out to the cash.
All right. You can use it as long-term care insurance. You can also use it as so the benefit with having maximum cash value is that you can use that cash value for whatever you please. There are some features, the accelerated enhanced benefit rider. You're able to have access to the death benefit for a terminal illness or a chronic illness, or you could also put on a long-term care rider. But there are ways of accessing the death benefit while you're living. Again, you always have access to the cash value in the form of a policy loan. There's that also. I'm gonna clear this. Did you capture it already?
Yeah, got it.
And the next one is just a continuation of that. All right, how long is the loan term? So there is no term. That's part of the beauty of taking a loan policy, is that you you determine the term. It's very flexible like that, but it also requires discipline. So I highly suggest that you create a term that works for you and you stick to that. But it is flexible. There's no repayment plan. Insurance companies are able to do that because they're collateralizing your death benefit, and at some point you'll die and they'll get their money that way. So they'll just take it out of the death benefit and then give your beneficiaries the remaining amount. So
Of course, what are some things void the contract if you commit suicide or but you gotta read the fine print, but like off the top of your head.
Yeah, so usually there's just a 2-year hold for suicide. So it's still, most companies will still pay out for suicide, but it's a 2-year hold. Yeah, every policy, product, or company is different. So yeah, you would have to read the fine print. Just going back to the long-term care or the enhanced accelerated benefits, some of those, if you develop a chronic illness or a terminal illness, but if it was a result of maybe a suicide attempt or drug use or drug abuse per se, some of those won't be covered. So you do have to qualify for some of that. Again, that's not why we're using the product, but just to be aware of that. And again, you have access to the cash value.
One thing that I would say is if you're a smoker, put your smoker on the thing, because I've seen them throw out policies or payouts based on that. They can prove otherwise, but any other things like that goes without saying, but I gotta say it.
Yeah. No, yeah, that's right. The company reserves the right to have the final say. And yeah, if on your underwriting you said you never smoked and then you have lung cancer and there's signs that you passed away because of that, that may cause the company to say we're not going to pay this out, or at least reduce it or something. But to touch on that too, a lot of times because we're not necessarily doing it for the death benefit, who you insure sometimes doesn't matter if it's within your family. So say a spouse, if the male has some underlying health conditions, that's where maybe you say, hey, we're going to insure the wife who's healthy, and the policy can work and you have access to that cash value. Then there's the owner of a policy, the beneficiary of a policy, and then the insured. A lot of times the owner and the insured doesn't have to be the same person.
It's just, I think the only issue is like if you get it on your, I know you always all have access to their online portals, do whatever you want. But if you have to call something in, I think that they have to call it in for you potentially, or maybe you have to designate them as.
Yeah, sometimes, yeah. A lot of times with the online portal, it's like online, it's a joint account online banking at times. So
I told my wife we're gonna make our next Simple Passive Cashflow shirts are gonna be for our spouses. Like, I'm only here because I have to co-sign this loan, husband. Hey, what do you mean I can't put the loan in you can't put the loan for your rental property in your name? I don't get it. Just don't worry. Just sign the stuff. The same thing. But I don't know. What did you do? Did you store it all under you personally?
No, it's split. My wife has one. We're actually opening up another one, and then I have a couple of mine. So,
okay.
Yeah, I split it just to
keep it even, because you'll be super sad if she goes away. So yeah, I think it's all on me. Maybe that's the intention, right? If financially I'll be okay.
Yeah.
But I don't know, that's another, and then I think this is where you talk with the individual people and just see where their head's at and just get on the right person. I mean, it's not super important, but something to think about too. Who's the beneficiary? All
right, we're getting down to the last few. Can you set up a 1-year paid up policy versus 6 to 7 year policy? Yes, you can. I'll tell you that a 1-year lump sum payment will not perform as good. It's counterintuitive. You'd think that you front load it and you stuff it all in, that it'll start earning dividends. But remember that there's that MEC limit. So in order to be able to pay a certain amount, they're looking and saying, okay, you're going to have to pay that amount for the 7 years, even if you don't pay it. So in order to lump sum this large amount in year 1, you're going to need this huge death benefit, because it's going to look like you're paying that premium for the next 7 years. So it's that large death benefit will eat away at all of the costs versus spreading the payment out between 2 or 3 years. I like to say 5 is probably the shortest. 7 is the most efficient as far as stuffing the most in, but you can see very good returns in the 5-year one. It's just because you're paying for funding it for 7 years, even though you're not.
A lot of people will do 10 years because it's a round number, But I would argue, as I had said earlier, like your life situation will change every 5 years. A lot of you guys are on the fast track financially. To me, the shorter, the better. But I didn't know that. I didn't know you could just do 1 or 2 years, but I didn't know that. But it
Yeah.
makes it, the sweet spot is 6 to 7 years.
Yeah, and definitely we can set something up. I'll show whatever policies and we can illustrate it. And that's where we just compare things side by side. Things will behave differently for each individual. So it's always best to just illustrate it and put it on a spreadsheet and compare it and look at it.
Yeah. Don't do that with Tyler. Do it with the other guys. Have them go through that rigmarole. Just do it with us because we'll beat them on pricing anyway. So it seems like a pain to do.
I think this one we sort of, yeah, how does the loan usually need to be paid back annually, quarterly? It technically doesn't. If you don't make any interest payments, the policy will just start borrowing from itself, or the cash value will start going down as the need for interest grows. So that's what's happening. And then at some point, it could erode all the way. But there's ways of designing it too. It matters what people's goals are. Some people, they want to, when they're age 60, start drawing 50,000 a year for 20 years or so. So that's how we're deciding the funding period or the funding amount to reach that goal. And their intent is they take out that $50,000 loan, make 0 payments, and want the policy itself to still maintain. So it's just tweaking the policies in that sense.
Kind of exactly like a reverse home mortgage, right?
Yeah.
Something like community coastal. We have a spreadsheet of this stuff, but since we're recording this, the banks change all the time. But I don't know, when you guys do your call with Tyler, he can share the sheet with you guys. There's like about 12 different banks across the country. Some of the people in the family office group helped us out and called them all and then talked to the people. So we have the names and contacts of the people that you want to work with. If you want to do that. I personally don't. I think it's a pain to do that. I don't utilize my entire cash value loan, but if you had a cash value of more than $250,000, it might make sense for you to do that. But they're really these obscure banks. Like, I've never heard of these banks before. They should send us a coffee mug for sending all these random people from California, Hawaii, Washington, Texas out. Any last question?